Today, we're going to count down 10 exchange-traded funds that have not only helped investors build significant wealth but are also poised to continue their millionaire-making journey into 2026 and beyond. We'll dive into real data, showing you how these funds have performed and why they're worth your attention. And trust me, you'll want to stick around for number 1. It has recently outperformed both the S&P 500 and the Nasdaq 100, making it a true standout in the current market. Number 10. Vanguard FTSE Emerging Markets ETF, VWO. Tapping into global growth. VWO is your passport to the world's fastest-growing economies. It invests in companies located in dynamic emerging market countries like China, India, Brazil, Taiwan, and South Africa. These nations are often characterized by rapidly expanding middle classes, increasing industrialization, and significant technological adoption, offering a different growth profile than developed markets. VWO has shown solid performance, especially in recent times. As of August 2025, its year-to-date return is an impressive 16%. While its 3-year return is 9%, the recent momentum indicates a strong rebound and continued growth in emerging markets. VWO offers broad, diversified exposure to emerging markets, which can be more volatile than developed markets but also offer higher growth potential. It's managed by Vanguard, known for its low-cost index funds, making it a very efficient way to access these markets. The fund's low expense ratio, typically around 0.08%, means more of your money stays invested and compounds over time. It's perfect for investors willing to take on a bit more risk for the potential of greater returns, especially those looking to diversify beyond the US market and capture the economic expansion of developing nations. It's a strategic choice for long-term investors who believe in the global shift of economic power and the rising influence of emerging economies. Number 9. SPDR Portfolio S&P 600 Small Cap ETF, SPSM. The power of nimble growth. SPSM focuses on the often overlooked segment of the U.S. equity market, small capitalization companies. These are typically smaller, more nimble businesses that have significant growth potential, especially during periods of economic expansion. The S&P Small Cap 600 Index, which SPSM tracks, is known for its rigorous inclusion criteria, ensuring that only profitable and financially sound small companies are included, making it a high-quality small-cap index. SPSM has demonstrated strong performance, particularly over the medium term. Its 3-year return stands at an impressive 29%. As of early August 2025, its year-to-date return is 3%. In 2024, SPSM returned 9%. While small caps can be more volatile than large caps, their potential for rapid growth during bull markets makes them an attractive component of a diversified portfolio. Analysts expect earnings growth for SPSM's holdings to improve significantly in 2025 and 2026, signaling continued upside. Small-cap companies have the potential to skyrocket during favorable market conditions, as they often have more room to grow than their larger, more established counterparts. SPSM's incredibly low expense ratio, typically around 0.03%, and its extensive list of holdings, around 600 companies, make it a highly efficient and diversified way to access this growth segment. It's a favorite for aggressive investors looking for exposure to innovative, rapidly expanding U.S. businesses. By investing in SPSM, you're betting on the entrepreneurial spirit and growth engine of America's smaller, yet powerful, companies. This ETF is ideal for investors who understand the cyclical nature of small-cap performance and are willing to ride out periods of volatility for potentially outsized long-term gains. Number 8. VanEck Semiconductor ETF, SMH. Powering the digital revolution. SMH offers pure-play exposure to the companies at the very heart of the digital revolution, semiconductor manufacturers. These are the companies that design and produce the microchips, processors, and memory components that power everything from your smartphone and laptop to advanced AI systems, data centers, and electric vehicles. The semiconductor industry is highly cyclical but also characterized by rapid innovation and immense growth potential, driven by ever-increasing demand for computing power. SMH has been an absolute powerhouse, delivering phenomenal returns. Its 3-year return stands at an astonishing 116%. As of early August 2025, its year-to-date return is 22%, and its 1-year return is 31%. In 2024, SMH returned a remarkable 40%. This consistent, high-octane performance highlights the critical role semiconductors play in modern technology and the strong demand for their products. The immense momentum in the tech sector, particularly with the explosion of artificial intelligence, has directly fueled SMH's growth. Companies like Nvidia, a top holding in SMH, AMD, and Intel are constantly pushing the boundaries of chip design, creating the foundational technology for the next wave of innovation. Investing in SMH allows you to capture the growth of this essential industry without having to pick individual chip makers. It's a concentrated bet on a vital sector, making it a potential millionaire maker for investors who believe in the continued expansion of digital infrastructure and AI. However, due to its concentrated nature and the cyclicality of the semiconductor industry, SMH can experience higher volatility. It's best suited for investors with a higher risk tolerance who are looking for aggressive growth from a sector that is indispensable to the future of technology. Number 7. iShares Gold Producers ETF, SPGP. A golden hedge with growth potential. SPGP offers a unique blend of defense and growth by investing in top gold mining companies. While gold itself is often seen as a safe haven asset during economic uncertainty, gold producers can offer leveraged exposure to rising gold prices. When gold prices go up, the profits of gold mining companies can increase significantly, leading to higher stock prices. This ETF provides a way to participate in the gold market without directly owning physical gold, while also benefiting from the operational efficiencies and growth strategies of mining companies. SPGP has shown strong performance, particularly in the past year, highlighting its role as a powerful hedge against inflation and a growth tool during periods of economic volatility. Its one-year return is an impressive 46%. SPGP acts as a powerful diversifier in a portfolio. Gold and gold mining stocks often move independently of the broader stock market, providing a valuable hedge during downturns. When inflation is a concern, gold tends to perform well, as it's seen as a store of value. Furthermore, advancements in mining technology and exploration can lead to increased production and profitability for the underlying companies, adding a growth component to this defensive asset. It's ideal for investors looking to diversify their portfolio, protect against inflation, and potentially benefit from rising gold prices. While it can be volatile due to commodity price swings, its role as a defensive asset with growth potential makes it a compelling choice for those seeking a balanced approach to wealth building. Number 6. Vanguard Growth ETF, VUG. Investing in America's Innovators. VUG is a classic choice for investors seeking exposure to large-cap U.S. growth companies. It tracks the CRSP U.S. Large Cap Growth Index, which includes some of America's most innovative and rapidly expanding businesses. These are companies that are expected to grow their earnings and revenues at a faster rate than the broader market, often reinvesting profits back into their operations to fuel further expansion. Think of the tech giants and consumer innovators that are shaping our modern world. VUG has been a consistent wealth-building engine for long-term investors. Its 5-year return stands at an impressive 75%. Its underlying holdings, which include powerhouses like Apple, Microsoft, Amazon, and Nvidia, have shown strong performance. For instance, the broader technology sector, which heavily influences VUG, has seen significant gains in early 2025, suggesting VUG has continued its upward trajectory. Its 10-year return of 145% further solidifies its position as a reliable growth vehicle. VUG's strength lies in its diversification across leading U.S. growth companies and its incredibly low expense ratio, typically around 0.04%. This means you get broad exposure to the companies driving innovation and economic expansion in the U.S. at a very low cost. It's a foundational ETF for investors who believe in the long-term growth potential of American industry and technology. VUG is ideal for disciplined investors who are looking for a straightforward, low-cost way to participate in the growth of the U.S. stock market's most dynamic companies. It's a core holding for many long-term portfolios, providing consistent exposure to companies that are at the forefront of innovation and market leadership. Number 5. Franklin FTSE Korea UCITS ETF, FLKR. Riding Asia's Innovation Wave. FLKR provides targeted exposure to South Korea's dynamic and technologically advanced market. South Korea is a global leader in innovation, particularly in semiconductors, electronics, and automotive industries. This ETF allows investors to tap into the growth of companies like Samsung, Hyundai, and other major players that are at the forefront of technological development and global trade. It's a strategic choice for investors looking to diversify their international exposure beyond the typical emerging markets. The South Korean market, especially its tech sector, is highly sensitive to global economic conditions and semiconductor cycles, which can lead to volatility. FLKR is an excellent choice for investors seeking diversification beyond the US and broader emerging markets. South Korea's economy is driven by innovation and exports, making it a compelling growth story. The ETF's low expense ratio, typically around 0.09%, makes it a cost-effective way to access this market. It's ideal for investors who believe in Asia's continued economic rise and the technological prowess of South Korean companies. While it carries the inherent volatility of a single-country emerging market ETF, its potential for high growth makes it an attractive option for those looking to add a strategic international component to their portfolio. Number 4. Invesco Technology S&P US Select Sector ETF, XLK. The heart of American innovation. XLK is a powerhouse ETF that provides concentrated exposure to the technology sector of the S&P 500. This means it invests in the biggest and most influential US tech giants, companies that are driving innovation and shaping the future of industries worldwide. If you believe in the continued dominance of American technology, XLK is a direct way to invest in that conviction. Its holdings are primarily focused on software, hardware, and IT services, making it a pure play on the core technology sector. XLK has consistently delivered strong returns, reflecting the robust growth of the U.S. technology sector. Its 3-year return stands at an impressive 113%. XLK's strength lies in its focus on a select group of highly influential companies. Its top holdings include household names like Apple, a global leader in consumer electronics and services, Microsoft, a dominant force in cloud computing and enterprise software, and Nvidia, the undisputed leader in AI chips. These companies are not just large, they are innovators that continue to expand their market reach and profitability. While XLK is less diversified than a broad market ETF, its concentration in high-performing tech giants has historically led to significant gains. It's ideal for investors who want to capture the power of high-tech innovation and are comfortable with the higher volatility that can come with a sector-specific ETF. For those who believe that technology will continue to be the leading engine of economic growth, XLK offers a direct and powerful way to participate in that future. Number 3. VanEck Defense ETF, DFEN. A stronghold in volatile times. DFEN offers a focused investment in the defense and aerospace industry. This sector includes companies that produce military aircraft, defense systems, cybersecurity solutions, and space technology. In an increasingly complex global landscape, defense spending often remains robust, providing a degree of stability and growth potential that can be less correlated with broader economic cycles. This ETF is a direct way to invest in the companies that are essential for national security and technological advancement in defense. Defense stocks have seen a significant surge, particularly in 2025, and these ETFs have been crushing the broader market. As of August 2025, DFEN boasts an impressive year-to-date return of 59% and a 1-year return of 83%. This remarkable performance highlights the sector's strength amidst geopolitical developments and increased global defense budgets. The fund's ability to deliver such strong returns makes it a compelling option for investors seeking growth in a sector often considered defensive. The defense industry is characterized by long-term contracts, high barriers to entry, and consistent demand, making it a relatively stable sector. Companies like Lockheed Martin, Northrop Grumman, and Raytheon Technologies, common holdings in defense ETFs, are global leaders with established technologies and strong government relationships. Investing in DFEN allows you to benefit from this stability and the recent surge in defense spending. It's ideal for investors looking for a sector-specific play that can offer both growth and a hedge against broader market volatility. While it might not align with every investor's ethical considerations, from a purely financial perspective, the defense sector has proven to be a resilient and high-performing area, especially in the current global climate. This ETF is for those who recognize the strategic importance of the defense industry and its potential for sustained financial performance. Number 2. Vanguard S&P 500 ETF, VOO. The classic millionaire maker. VOO is arguably the most well-known and widely held ETF, and for good reason. It tracks the S&P 500 index, which represents 500 of the largest and most established companies in the United States. When you invest in VOO, you're essentially owning a tiny piece of America's biggest and most successful corporations, covering a vast array of industries from technology and healthcare to finance and consumer goods. It's a foundational investment for anyone looking for broad market exposure and long-term growth. VOO is a proven millionaire maker for patient, long-term investors. Its 10-year return stands at an impressive 145%, and its 5-year return is 75%. As of early August 2025, VOO has a year-to-date return of 10% and a 1-year return of 22%. These consistent returns demonstrate the power of investing in the broad U.S. stock market over the long haul. The S&P 500 has historically delivered strong returns, making VOO a reliable vehicle for wealth accumulation. VOO's success lies in its simplicity, diversification, and incredibly low cost. With an expense ratio of typically just 0.03%, it's one of the cheapest ways to get broad market exposure. This low fee means more of your money stays invested and compounds over time. By owning 500 companies, VOO provides instant and extensive diversification, reducing the risk associated with individual stock picking. It's a set-it-and-forget-it investment that allows you to participate in the overall growth of the U.S. economy. For those looking to build wealth steadily and reliably over decades, VOO is often considered a core holding in any well-diversified portfolio. It's a testament to the idea that sometimes, the simplest strategies are the most effective when it comes to long-term investing. Number 1. Invesco S&P 500 Momentum ETF, SPMO. Chasing the market leaders. SPMO is a fascinating ETF that employs a momentum strategy. This means it invests in 100 of the S&P 500's fastest rising stocks, companies that have shown strong recent price performance. The idea behind momentum investing is that stocks that have been performing well tend to continue performing well in the short to medium term. The fund is rebalanced every 6 months, allowing it to adapt to changing market leadership and continuously capture the strongest trends. It's a dynamic approach that aims to capitalize on market psychology and investor behavior. SPMO has been a standout performer, living up to its momentum strategy. Its 3-year annual return is an impressive 29% per year. As of early August 2025, SPMO has a year-to-date return of 18%, and its 1-year return is 46%. SPMO has recently beaten both QQQ, Nasdaq 100 ETF, and SPY, S&P 500 ETF, which is a significant achievement given the strong performance of those broad market indices. This demonstrates its ability to identify and ride the strongest trends in the market, helping smart investors achieve huge gains. SPMO's strength lies in its systematic approach to identifying market leaders. By focusing on companies that are already demonstrating strong upward price trends, it aims to capture the continued upward movement. This can lead to outsized returns during bull markets, especially when certain sectors or companies are experiencing rapid growth. While momentum strategies can be more volatile and are susceptible to sudden market shifts, SPMO's semi-annual rebalancing helps it adapt and rotate into new leaders. It's a compelling option for those chasing market leaders and seeking aggressive growth. It's ideal for investors who are comfortable with a more active strategy and believe in the power of market trends to drive returns. If you're looking for a fund that aims to be at the forefront of market performance, constantly seeking out the next big winners, SPMO could be the top pick for your portfolio. So, how did real investors turn these ETFs into million-dollar portfolios? It wasn't magic, it was a combination of discipline, smart strategies, and patience. Here are the key takeaways. Invest consistently. The most crucial habit of millionaire ETF investors is consistency. They invested monthly, regardless of whether the market was up or down. This strategy, known as dollar-cost averaging, removes emotion from investing. Instead of trying to time the market, which is nearly impossible, they simply set up automatic investments. This ensures they buy more shares when prices are low and fewer when prices are high, averaging out their purchase cost over time. It's a simple, powerful way to build wealth without stress. Reinvest dividends. Many ETFs pay dividends, which are portions of a company's earnings distributed to shareholders. Millionaire investors didn't take these dividends as cash, they reinvested them back into the ETF. This allows their earnings to buy more shares, which then generate more dividends, creating a powerful compounding effect. It's like a snowball rolling downhill, gathering more snow as it goes, growing larger and faster over time. This seemingly small decision can dramatically accelerate wealth accumulation. Diversify wisely. While ETFs themselves offer diversification, smart investors also diversified across different types of ETFs. They didn't just stick to one sector or one type of fund. Instead, they mixed tech funds with gold funds, global market funds with value funds, and growth funds with defensive funds. This broader diversification helps to lower overall portfolio risk and increase returns by ensuring that even if one sector or region is struggling, others might be performing well. It's about building a robust portfolio that can weather various market conditions and capture growth opportunities from multiple angles. We've explored 10 powerful ETFs that have helped many investors build true wealth, combining long-term discipline with powerful market trends. From the broad market exposure of VOO to the targeted growth of SMH and the defensive strength of SPGP, there's an ETF for every investment goal and risk tolerance. Which ones are you using, or planning to buy? Drop your ETF picks in the comments below. We'd love to hear about your strategies and experiences. And don't forget to subscribe for more.